framework, the last part of it. If you look at this equation, asset equal equity plus liability, please take note. What comes under each category when you do your accounts publishing? Nowadays, you have non-current asset. Please use international language, don't say fixed asset, it is non-current assets. Then you have current assets, which make up total assets. Right? Non-current asset, current asset make up your total assets. Liability, you have non-current liabilities. And you also have current liabilities. Definition is anything within 12 months payable must go to, strictly when you do reporting and proper presentation, anything payable within 12 months must go to current liability, exceed 12 months must be in non-current liability. So this is how you look at current and non-current. The difficult part in doing a lot of work in P2 is this equity section, which has become very, very interesting because of the OCI in the P&L. Right? So when you do the equity section, what do we have under equity? Under equity you have share capital. Please take note. Share capital is at par value. International paper has par value. So every share has a registered value, $1, 25 cents or 50 cents or whatever. The registered value of the share is called par value. And share capital is always maintained at par value in international paper. Right? So it's only the par value. But if you sell the share above par value, if the share is $1, you sell the share for $1.50, then the 50 cents extra you earn is called share premium. Share premium and other reserves are all gains made by the company that belong to shareholders. And these are now classified under one word in the latest framework as OCE. What is OCE? From today you will hear this word very often. OCE is other components of equity. This is called other components of equity. In short, I'll be using the word OCE because it's too long to say, okay? So whenever I say OCE, what is an OCE? Other components of equity means share premium, that you gain profit on selling the share. You revalue asset to fair value, you make a gain, right? Those gains are called revaluation reserve. Things like this all go under OCE. So these are all gains that you have for the shareholder, which are put under OCE. And a lot of things in this OCE come from the P&L OCI. Alright, P&L has got two sections nowadays. One is the profit section. Below the profit, you have the other comprehensive income section. The other comprehensive income section has got items which you're going to learn from the standard. As you go through the standards, I'll tell you about the OCI. But if you want to see an idea what is in the OCI, alright, if you want to get an idea what is in the OCI, if you turn to the presentation on page 35, got it? Please look at presentation on page 35. Can you see? On page 35, you have a P&L in the current framework, current requirements for presentation. If you look at the P&L, first part is the normal P&L until profit for the year. Can you see? Right? That is the operating business profit, which is profit for the year. Below the profit, you see other comprehensive income. Right? Some of this can be reclassified to P&L later. Some cannot be reclassified. Don't worry about all that. Look at the items under OCI. Gain on property, revaluation. Can you see? Actuarial gain or loss on pension plan. Okay, loss on property, revaluation of associate. Below you have exchange differences on translating foreign operation. Can you see? Then you have financial asset available for sale, gain or loss, cash flow hedges, gain or loss, and things like this are coming up one by one when we open the standards. At that time, I'll tell you, this item goes to OCI, this item goes to P&L. When I say P&L, it goes to profit. When I say OCI, it goes to part 2. Anything in OCI will join OCE, understand? So if you put something in OCI, that figure in OCI will also come into OCE. So OCE or other components of equity are gains or losses made but not realized yet. That means earn or haven't earned. Whatever you already earned, you put under P&L. That means you already collect the money or you already earned the profit. If it is already realized or earned, it goes to profit. But revaluation, you push up your asset. When you push up your asset, that gain you haven't earned yet until you sell the property, yes or no? So, until you sell the property, all the revaluation which you got by increasing the asset to fair value, you hold it under OCI, OCE. The day you sell the asset, you realize the profit. When you realize the profit, you cannot keep it in OCI, OCE anymore. You must take it out and put it into retained earning. So the logic is very simple. If you already earned the profit, it can go to P&L. But if you take a gain or loss which you haven't earned, but you haven't realized but recognized, we call it recognized but not realized. Anything gain or loss recognized but not realized will be put under OCI, OCE. Anything in the OCI will join the OCE as other gain. And these gain will come from OCI to OCE. Then you have retained earning. Retained earning, for your information, is the profit accumulating over the year. That is called retained earning. So your reserves are made up of two things in reporting. What are the two things in reserves? OCE and RE. So what is the difference? Anything in OCE is already recognized but haven't realized. Anything in retained earning is already earned or realized. So they are all profits. Listen, they are all profits that belong to who? Belong to your shareholder. Only difference, recognized but not realized. The other one is already recognized and realized already. Then it comes under retained earning. So what is inside retained earning? Retained earning, when a company makes profit, you know from the beginning itself, any profit made by company is not returned fully to who? Shareholder. Companies must retain profit for future expansion. So when you put retained earning, normally you have the opening retained earning, yes, plus the first part you had a profit for the year, right? The profit for the year joined the RE. The OCI will join the OCE. So anything in the P&L you make gain or loss must come into reserve. So gain or loss in the P&L is transferred to the reserve, and in the opening RE you plus profit for the year. Got it? After plussing profit for the year, from the profit you declare dividend. Dividend will reduce your profit, correct? Minus the dividend will give you this figure called closing retained earning. Understand? So profits are treated separately, OCE is treated separately. The difference is OCE cannot be distributed as dividend. Only retained earning can be distributed as what? Dividend. That's why in companies you have distributable reserves and reserves that cannot be distributed. Or anything in OCE cannot be distributed as dividend. So it's called undistributable reserves. Retained earning is what? Is the only distributable reserve. So you can only declare dividend from where? From the RE, retained earning. So you have two parts here to prevent complication, make it easy to understand. Share capital will be at a registered value. OCE will be those gains which are already recognized but haven't realized. Retained earning are those gains or losses already recognized and what? And realized. Put this together, plus for group of companies. When you do group of companies, you also have to put one more thing inside called NCI. What is NCI? Non-controlling interest. When you have minority interest, they come under equity. Don't put NCI under liability. NCI is under equity. So the categorization in your subject is asset, equity, liability. And what students find very confusing as I go deeper into the subject in the coming lessons will be this OCI, OCE. People always ask me, how to see OCI, OCI, you say OCI, OCE, OCI, OCI. You know, how do I know? Today onwards, please remember this. When I use the word OCI, OCE, it means what? Already you took a gain, because accounting says true reporting, you must do fair value, right? If you put historical cost, you won't have any problem. Why? You can keep the numbers at historical cost. But accounting says for true and fair presentation, you must bring numbers to what value? Fair value. When you bring something to fair value, it is putting it up for the purpose of reporting truthfully. But have you earned the money or haven't earned? Haven't. So what to do with that? Got to put somewhere, right? Where to put? Cannot put under P&L. P&L is earned. That's why the subject came up with this word called OCI. So OCI was brought in to hold all this gain temporarily. So all the gains that you haven't earned, you hold in the OCI, you shift it to the OCE, and this is a reserve. So under this OCE, you have a lot of things coming up every lesson. Next week, you will see revaluation, how it comes in. Do you follow? Then later, you will see how pension fund comes in. Understand? So every standard I open, I will show you how the OCI flows in one by one. That's where you understand how to report correctly. So by the beginning, you must understand the difference between OCE and RE. They are totally different. Don't confuse it. Alright? And this is what equity is in your subject. So at the end of the day, what is equity in P2? Share capital, OCE, retained earning, NCI. And today OCE, you know two things. One is share premium. All share premium, we don't have a separate line nowadays in reporting. They are called OCE. Alright? And the other thing that you have here, which you will know by next lesson, is what reserve? Revaluation reserve. Which I'll tell you next lesson how this is done. Today, get the whole picture first, okay? So this is the logic of OCE. Alright? Once you do this, this is how you look at the equation for a listed company, please. Okay? Once you know this, then we come into accounting standards. Let's clear up all this stuff so that we start with proper understanding. If not, the standards will get very blurred. So accounting standards, how are they set? What do they tell you? What kind of standards are there available? To make it to the point, accounting standards are specific rules. Framework is a general guideline. Agreed? Standards give you specific rules. Specific rules, standards are set by who? Standards are set by the International Accounting Standards Board, IASB. And the process of setting a standard is always, if there's a problem or a loophole in reporting, if companies are manipulating successfully because the standard is very weak, what they normally do is they come up with a first step in developing a proper standard. The first step in developing a proper standard is to come up with a discussion paper. First step is to do a discussion paper, where all member countries are invited to discuss the problem, whether it's a problem in their country or not. Secondly, once they find that the problem is a real problem, then they come up with an exposure draft. They found there is an exposure draft. We call this ED. ED will draft the standard with all the changes inside. It is an existing standard. We change whatever we need to change, and that is called an exposure draft. Once the exposure draft is debated, member countries can make changes if they want to. Alright? When it's finalized, it can take very long, please. It is not overnight. Sometimes the discussion paper can start very early. Standard may come out very much later. Some may even take 6 years, 7 years for a standard to come out. The whole process is not within 1 week or 2 weeks. It is all a long process, please. They identify a problem, they discuss whether it's a serious problem or not. That can go on for 1 year, 2 years. Then they draft the standard. Then they say, okay, this standard, okay, acceptable to all of you. Give your comment. When you give your comment, they take all the inputs, they change the whatever necessary to change. That may take another 1 or 2 years. The financial instrument standard took 7 years to develop, understand? The leasing standard, there was just released last year, FRS 116. The draft discussion paper already started in 2010. 2010 the discussion paper started. Standard only came out in 2017. So it takes a long time to finalize standards because you just cannot do it overnight. So all the process is from a discussion paper to exposure draft to a standard. Once a standard is accepted by all member countries, it becomes legally binding. And is taken to Parliament to get approval, and Parliament passes the standard as a law. Once it's approved in Parliament, it is automatically accepted as a standard by member countries. And what does Singapore do? Very simple. We don't develop any standards in Singapore. The international body IASB releases the IFRS. Alright? The IFRS comes out, for example, IFRS number 16 for lease. Singapore is going to adopt it. Of course, countries are free to adopt when they want. They give a timeline. Alright? Singapore wants to adopt this only in 2019. Got it? So you still have 1 or 2 more years before the lease standard is adopted in Singapore. But you are encouraged to do early adoption. It's okay to adopt early, but once it's adopted, you have to follow. And the critical standard adopted currently in 2018, 2017 is IFRS 15, which is your revenue. Revenue is already implemented from 2018 in Singapore. So this year, revenue is getting implemented in Singapore. So IFRS 16, they are waiting. After revenue is implemented, slowly we bring lease inside. So lease, we still use the old standard. But I cannot teach you the old standard because P2 requires you to learn only the new standard. The old one you can throw away. Below. So, but in Singapore, it's still not implemented yet. So IFRS 16, what does Singapore do? Very simple. Any standard release, we take the standard because you already given our comment. Alright, the final version is taken and we just blanco the I, become FRS. And it becomes our standard called FRS. We don't change anything. So IFRS 16 in Singapore is FRS 116. We add one more digit to differentiate from IAS 16, you see. Because IAS 16, the standard for PPE is called FRS 16, you see. So how to differentiate that one? We add one more digit. So all the new standards in Singapore got 3 digits. The older ones only got 2 digits. But in the international standard, the older ones are IAS. The newer ones are called IFRS. So we just take out the I, it becomes FRS, add 1 digit in front, it becomes 116. IFRS 5, held for sale, is FRS 105. Why 105? We just add 1 in front, that's all. So all the new standards got 3 digits. Alright? Revenue recognition is IFRS 15. IFRS 15, if you go in Singapore, is FRS 115. It's not 15, it's 115. Because we just add a 1 in front for all the new standards. And we just do this and we adopt the standard completely. We do not change anything or create new things in Singapore. That's all we do. That's why I'm telling you, whether you do international paper or Singapore paper, it's just writing the IFRS or FRS. Other than that, everything is the one same. So people get very upset. Oh, no more Singapore paper. It doesn't matter. They are the same thing. Alright, so at the end of the day, you don't have anything new. Understand? So these are the 3 things in IASB before they come up with any standard. And clearly, in any conflict situation, follow? In any conflict situation, standard supersedes framework. Standard supersedes framework. Please take note, standard cannot lose. A good example of this conflict, I can tell you today briefly, is this. Later we will do something called deferred tax. Understand? In tax we create deferred tax. Deferred tax, we have a deferred tax liability. Understand? A deferred tax liability is a liability created because of timing differences. We don't owe money to anybody. Understand? But we call it a liability. So if you follow the definition we went through just now, liability, there must be our outflow of, one of the key words for a liability, there must be outflow of economic resources. When you do a deferred tax liability, you don't owe money to anybody. But conceptually, it is a what? It is a liability. If you follow the framework, a deferred tax cannot be a liability. Why? It doesn't satisfy the three key elements. Because deferred tax, you don't owe money to anybody. We create a number to adjust for the what difference? Timings. So we call it a liability, you see. And what is deferred tax? Basically, income tax department give you the tax benefit earlier. To us, you give earlier, I cannot say no one. Yes or no? An asset lasts you 5 years. Income tax say, take this in 3 years. What is the answer? No. Give me 5 years. You want tax benefit early or late? If income tax tell you an asset, you can claim WDA, right? You know the allowance, capital allowance, you can claim in 1 year. But the asset life is 5 years. If asset life is 5 years, you claim tax in 1 year. To the tax person is okay. You see why? Income tax, if take lah. But to us it's a crime. Why? Because the benefit should be spread over how many years? You are depreciating the asset over 5 years. But income tax asks you to take the capital allowance in 1 year because of all your tax rules. Understand now? Whatever la, section 14A, 14B, 14C, all that la. Understand now? So they ask you to go and claim early. So you don't say don't want. You take the tax benefit in 1 year. But our matching concept clearly say you must spread this benefit over how many years? 5 years. So what to do? Income tax give me early, cannot say don't want. So what do? I collect the 1 year tax benefit and then I put it into what? Deferred tax and spread it over how many years? 5 years. That's why you call it deferred tax, you see. So logically, if I take from income tax early, who owe who? We owe income tax or income tax owe us? Actually, we don't owe lah. But conceptually, matching concept, we owe them the money, right? If anything happens, we have to return the money to them, right? Because they gave us 5 year benefit in 1 year. So we capture a liability, but we don't owe them any money. Then how? Framework say it's not a liability. IAS 12 say it is a liability. So who is right? IAS 12 is right. But the liability definition fail is okay. Framework can fail. Standard cannot fail. So every time we do our subject, we must remember that standard is our ultimate document we should follow. Framework, anything can be a problem. That is okay. Framework fail is fine. They will revise the framework to adapt to the new things. But standard cannot fail. So standard supersedes framework. And when standards are set, please take note, when standards are set, standards can be 3 types. Standard can be 3 types. When a standard is set, it can be rules-based. Later you will see all these issues. Or a standard can be principle-based. Standards can be rules-based, or it can be principle-based, or a standard can be a hybrid. Hybrid means it's a mixture of rules-based and what? Principle-based. What is the difference between the 3 types of standards we have, the categories, alright? Some standards are very strict. They tell you clearly, this is what you must do, you cannot do anything differently. The rules are clearly stated in the standard. Then it becomes a what? A rules-based standard. The US GAAP, the US standards are all, majority are rules-based. So in the US GAAP, a lot of them are rules-based. That's why they're going to make standards into one single standard. Alright, there is a timeline to bring all the standards into one standard worldwide. But it is very difficult to achieve because US standards are rules-based. International standards, IAS set, are all, a lot of them are principle-based. So there's a lot of difficulty in reconciling. So when it's a rules-based standard, there is a fixed treatment. Later when I do the standards, I'll tell you which one is rules-based, which one is principle-based. You will see the difference, alright? There is a fixed treatment in the standard and there is no flexibility. Every company must follow the same rule. There is no flexibility in applying the standard. So it's a standard application everybody must follow. But if it is principle based, the standard says you can decide a few things yourself. There is no hard and fast rule. So it gives you more flexibility. For example, if you look at FRS 16 or IAS 16, IAS 16 says depreciation, which method to use. I'll just give you a simple example. When you take an asset, depreciation, should we use straight line method, should we use reducing balance method, or should we use a sum of digits method? Got it? You look at the US GAAP, for different assets it clearly specify what method to use. But if you look at the international standard, it doesn't tell you what method. It only says depreciation method selected will depend on the type of asset, nature of asset, and the usage of the asset. When they give you sentences like this, you can decide the method because you got flexibility. The principal use is nature of the asset, usage of the asset. Depending on all this, you choose the method yourself. It doesn't tell you this asset must use this method, this asset must use this. It doesn't tell you clearly. If it tells you clearly as a hard and fast rule, it becomes a what based? Rules based. But if it tells you it depends on this factor, that factor, this factor, it becomes a principle based. So in principle based, you have the flexibility to choose the methods yourself, depending on the type of asset which you have. So anything which is principle based, there is flexibility. But with flexibility, there is a danger. What is it? Company may use this flexibility to manipulate. That's why principle based is easier to manipulate compared to what? Rules based standard. So there is flexibility, and the recent trend in IAS is, if you look at the latest lease standard, revenue standard and everything, they are moving more and more towards rules based. They are cutting down on the what base? Principle based. Because companies are using loopholes to manipulate. And when you give them flexibility, they manipulate. You don't give flexibility, they complain. So at the end of the day, IAS is caught between, IASB is caught between these two. Should we give them flexibility or don't give? They are moving more towards no flexibility. Better to tell them clearly, do this, so that no debate anymore. If not, we are sitting down there debating for no reason. Understand? So there is no flexibility if it is rules based. There is flexibility with different treatments if it is principle based. But some standards give you a little bit of flexibility and also fixed rules. Then it is a hybrid. A hybrid standard is a mixture of rules based and principle based. Quite a lot of standards in IASB are hybrid. It is rules based and principle based as well. Both are this is called a hybrid standard. So in doing standards, when you go through the standards later from next week one by one, I'll tell you which one is a rules based, which one is principle based, which one is hybrid. You can clearly see the differences when you do the standard. But broad categorization is 3 of them. If you know that, then we come into the next issue, the final issue in your framework is measurement. What is measurement? How do you put numbers on your SOFP and P&L? How do you measure the numbers accurately? What measurement methods do we use? So what is measurement? Measurement refers to monetary amounts. Monetary amounts to be carried in financial statements. Monetary amounts to be carried in financial statements are called measurements. So any figure you put on your financial statement, how do you measure the number correctly, accurately to do faithful representation? If you look at measurement, I've given you a few measurements on page 28. Please follow. All right. Page 28, you got measurement of the elements of financial statement. All right. Okay, under measurement, you can measure assets or liabilities at number 1, historical costs. Measurement can be at what cost? Measurement can be at historical costs. Historical cost means, by definition, traditionally this was the method used, is a price paid. This is the price paid for an asset on acquisition. If you keep the asset at acquisition price, then it is following what cost? Historical cost. So price paid for an asset on acquisition. This is called measuring at historical cost. The second way to measure, please learn some of these words. They are very useful when you come to standards again. All this will be words coming into your subject as you move along regularly. Alright? The second measurement is current cost. Current cost in reporting is also called, another word, replacement cost. This is another way to measure anything that you want to put. Another way to measure anything you want to put on the financial statement. What is the realizable value? What is the current cost or replacement cost? Compared to another word, measurement can also be realizable value. Measurement can also be realizable value. Realizable value, we will see this word in many standards called NRV. What is NRV? Net realizable value. Replacement cost and net realizable value, they are not the same. Please take note. What is the difference? Current cost or replacement cost means same asset I have today. If I buy a new asset to replace the asset, what will I pay? That is called replacement cost. So the current market price for a new asset, if I replace this asset, what will I pay? That is called replacement cost. But my machine is already 3 years old. If I sell this 3-year-old machine today, what will I get? That is NRV. So the difference is this. NRV is the sale price of your existing machine. Replacement cost is a price of the machine if I buy a similar machine. The answer will never be the same. Please understand the English. Current cost or replacement cost means cash price today. Cash price today for a similar asset. For a similar asset, if I buy this asset newly. For a similar asset which is new. This is called replacement cost. Realizable value is different. Realizable value is disposal value. Realizable value is a disposal value. Disposal value means how much existing asset which is 3 years old can be sold for, which is different from replacement cost. So disposal value is how much existing asset can be sold for today. That is realizable value. And causing a lot of problems in standards nowadays is number 4, which is where a lot of people struggle with the valuation and measurement. And what is number 4? A very important word in reporting nowadays called present value. Let me introduce all the English today. Present value is also another way of measurement called PV. What is PV? PV is important in a lot of standards because recognizing numbers in accounting, future payment, any numbers that involve future payment, you cannot take future value and report today. It is wrong. So if I have a payment due in 5 years' time, 5 years' time I need to pay $10 million. That $10 million when you report today, you cannot use future value 5 million. You must bring it to today value called present value. So measurement in your financial statement must understand it's not a future value, it is a present value. And present value is used for any future cash flow coming out. So it affects many standards. Until you understand this word, you will keep doing a lot of PV in your life. So it's future cash flow. When you recognize in financial statement, all future cash flow is recognized at present value today. All future cash flows are recognized at present value today. And present value formula is 1 over 1 plus r to the power n. This is the PV formula that you need to know to handle this measurement. And R refers to the company discount rate. R refers to company's discount rate. Please take note. This is what we call reporting PV. So for example, when you let provision, you're making a provision today for a future loss payable in 5 years time or 3 years time, let's say. If you're paying $10 million in 3 years time, this money is only in how many years time? 3. Today when you report your provision, your debit credit, you cannot do for 10. Because today the 10 million is worth lesser than 10. So to do that, you must do a PV. To do a PV, you take the 10 million payable in 3 years time, divide by 1 plus R. R is your company's what rate? Discount rate, which the examiner will give you. For example, if it is 10%, you take 1 plus 0.1 power 3. Why power 3? Because this money is payable in 3 years time. Find a PV number today to start the reporting. And today the number is only 7.51 million. This 7.51 million is a PV. So your double entry today, if you're doing a provision, for example, which you'll be doing later, debit P&L, Y is an expense, credit provision. But this provision, you must understand, is today value, right? So whenever you capture a PV number, which is today value, when you pay the number in 3 years time, it cannot remain at 7.51. In 3 years time, this number must grow back to, today you capture PV, 3 years time the number must go back to 10 million. To do that, it is compulsory if you take PV to unwind the discount. So all PV numbers, you have to do unwinding. What is unwinding? Bring back the number to how many million? 10 million. How do you do that? First year, start matching the expense correctly. First year you take 7.51 million, which is the PV number, multiply by 10% because you use discount rate 10%, right? So first year you got to unwind 0.751 million. This 0.751 million, you debit finance costs. All provision when you, or all PV when you unwind, it will affect what cost, please? Finance cost. And this is why when you do finance cost in P2, there's a lot of this PV problem inside, which is unwinding every year. So debit finance cost, credit provision, automatically what happens? Your provision figure grows bigger after 1 year, right? Credit, you plus, right? Then go second year. Second year, this number has grown bigger to 8.261 million. And this is heavy going in many standards, please. Especially financial instrument. You will do a lot of this PV everywhere until you're tired, okay? Full of PVs in many standards, compulsory some more, no choice. So, take 8.261 million, we unwind another 10%. If you unwind another 10%, it will be 0.8261 million. That again, second year you debit finance cost, credit provision. This is what you call time value of money, yes or no? So you're unwinding the time value of money through what cost? Through a finance cost, same double entry second year. By the third year, you make sure that the number come back to 10 million ready for payment, right? So check the latest number, 8.261 plus 0.8261. Latest figure is 9.0871 million. Multiply by 10%, which will give you approximately, to round it up, decimal errors will be there. So final year you round up 0.9129 million. This figure will come back to how many million, please? 10 million. So basically you start with the PV number, finish with a PV number, finish with a future value number. This is compulsory for any future cash flow in all the standards. You measure future cash flows only by using our place present value. The minute you have a present value anywhere in P2, you have to unwind. It comes naturally in you as you move along. Okay? You cannot stop the unwinding in any PV number. So you can measure things in 4 ways: historical cost, current cost, NRV, or PV. 2, 3, and 4. Listen. 2, 3, and 4 are what we call fair value. So if people ask me, what is fair value? Is it market value? My answer is yes. Then people say, is it selling price? Yes. So what is it? Any of the 3. PV is also what value? PV is also a fair value. That's why it was very confusing when they introduced fair value. Alright? So the standard setters, people who implemented fair value, they were not consistent. Some company used replacement cost, some company used NRV. There was no consistency. That's why they came up with a standard which is IFRS 13 to fix this fair value. How to decide the fair value, whether to use number 2, number 3, or number 4. Which one to use? There must be something to guide you, right? So we need a standard. That's how IFRS 13 came in 2 years ago. When IFRS 13 came in, when to use current cost, when to use NRV, when to use PV were all set down clearly. So companies got a guideline to follow now through the standard which is IFRS 13. So this is the framework that introduces all the concepts. Then we start on the first standard today because you're doing fair value, PV and all that. Let me finish IFRS 13. First standard for your good health. Ready? Ready? Let's talk simple English in class and understand technical things. I'll tell you clearly, go back and read. Alright? For IFRS 13, there are some very good articles examiner has written. You must read those articles below. If you look at some of the things on presenting the framework on page 37, there's an article on how to present financial statements. Why got OCE, OCI, understand? Again, it caused a lot of confusion in the companies. So, examiner wrote an article. And then on page 41, mark this page please. Very important. On page 41, 42, not very long, only short article. They wrote this article after many students complained to the examiners. This OCI, OCE, we put everywhere, is very confusing. We don't know how to differentiate. So they came up with an article, what differentiates profit or loss? The OCI and the profit, how to differentiate. They wrote a complete article on how to differentiate. Very important, page 41, 42, if you read, you will understand, based on what I just explained to you just now, difference between OCI and profit. Alright, then on page 43, there are multiple choice questions. Do you follow? For you to further reinforce your understanding. Alright, to reinforce your understanding of all this presentation, OCI, OCE, and so on. Got it? It's a lot of English there, and multiple choice, I got no answer. So before you ask me where is the answer, if you look carefully, there's a small dot beside the alphabet. Do you see? If your eyes is sharp, you can see. Can you see? So anywhere got MCQ, don't ask me where's the answer. You just put your powerful eyes and look for the dot. Understand now? The one with the dot is the correct answer. Do you follow? Hello? Okay, so all the answers are there. You just got to read and apply. Alright? And the answers are those alphabet with the dot beside. Okay? Then there are some exam questions with answers on the framework. Got it? Some previous exam questions all involve writing. Framework got no calculation, only writing. Got it? You from page 44 are all the questions on the framework. Alright? One question with an answer there you have on framework. Alright, pleasure reading at home. Very simple. If you got no time to read, before you go to bed, take it as bedtime reading. Understand? No? Why? If you don't feel sleepy, you will sleep very fast. Okay? You read one article halfway, sure sleep one. Okay? Why? Life is so exciting. Alright? Then page 48 you have IFRS 13. Hello? This is the first word we learned today. What is it? Fair value. What is fair value? how to determine fair value. Let's progress with the understanding of the framework into what? Into standard. So, this is the first standard we are opening today. Got it? And I open with this because we're going to use this word everywhere from today. Every standard I open, you will see fair value, fair value, fair value, PV, PV, fair value. You will see every lesson talking about PV and fair value. So let's open with this. What is a fair value? How to define a fair value? What does the standard want you to do for fair value? Got it? Of course, depending on the asset, IFRS 13 say you must do the fair value measurement as accurately as possible. Don't do by guesswork. Understand? Please don't do by guesswork. Try to determine fair value accurately using the rules in the standard. So to do this, IFRS 113 was brought in because the principles were as follows. In doing fair value, you apply 4 important principles. In recent examination, in the last 5 to 6 papers, this has been coming out every paper without fail, at least one issue, where they ask the keywords on this standard plus how to determine fair value. So I'll tell you some of the summary of what is important here. After that, you can read page 48. And then the examiners always are very helpful. They write articles in order to make sure that you understand the concept. Your examiner is Graham Holt. He wrote an article on page 53. Do you follow? How to measure what value? Fair value. And people said, this is very difficult to understand. So he wrote another article, which was quite recently on page 59. Follow? All the resources have collected for you already. So you just got to focus and read what is in the notes you have to read. That I cannot do in the class because you will sleep before me. So please do the reading. I'll tell you what is in the article clearly. Go back and read after you listen. It is easier for you to understand. If not, it's highly technical. You may be lost in the middle. Do you follow? So listen to what there is inside there. Then you go and read. I'll simplify it for you in simple technical language. You take it and look at the writing clearly. Alright? So, 4 principles in using IFRS 13. I would look at it like this. By the definition in IFRS 13, fair value is defined. If you want a summary, please take it down. Alright? Or if you think you can read and understand it, please follow. Alright? After reading the article, what must you know? You must know these 4 things to do fair value. Fair value is defined as the price. Fair value is the price that would be received. Price will be received to sell an asset. Sell an asset or paid to transfer a liability. Because fair value can be applied to asset as well as what? As well as liability. Don't look at asset alone. The examination, they can test you liability as well. So to sell an asset or pay to transfer a liability. What you receive to sell an asset or what you pay to transfer a liability in an orderly transaction. An orderly transaction between market participants. Between market participants. As you can see from the English, everything is related to one word, market. Understand? So it must be focused on the one, market. So therefore, please take note, fair value in simple English, first way of looking at it, it is an exit price. Simple way of looking at it, it is our price, it is an exit price. To come out of something, what do you pay for? What do you pay for it? That is what you call a what price, please? Exit price. Then, number two is fair value concept is focused on the market. As far as possible, it must be focused, any fair value should be focused on market assumptions. In other words, standard says it must be preferably from the market. So it is focused on market assumptions and must be obtained from marketplace. Must be obtained from marketplace. As long as it is available and it is not a company specific value. Fair value is not, listen to the English, is not a company specific value. In other words, standard do not encourage you to estimate this value in your company yourself. It should be, as far as possible, a market focused value. So focus on what place, please? Marketplace. Alright? Thirdly, what you are saying is this. You have a property. Listen. The English, please follow simple explanation. You have a property. The property in the market, current trading in the market, the property is selling for 40 million. Alright? So, you want to do a fair value. This property in the market is currently trading for about 40 million. But somebody came and offered you 45 million. Hello? Somebody came and offered you 45 million. So when you do a fair value, when you report today, you haven't sold the property, right? Should I use 45 or should I use 40? Alright? 45 is a company specific value because somebody offered you, right? He may be joking, right? He may not be serious, right or wrong. But he offered you 45 million. But the true value of this property in the market trading place is 40. So if market focus, you must use 40 and not the offer 45. See? 45 is the company one. Specific value because somebody offered you, right? But you're not selling it yet, you haven't sold it yet, you don't know whether you can get the 45, so better to use 40 or 45. 40, don't overstate. So what we are saying is be more focused on the market. And also, number 3, third principle, when you do fair value assumes transaction to sell an asset, transaction to sell an asset or transfer a liability, sell an asset or transfer a liability takes place in a principal market. Next keyword. Even the price that you get or that you include should take place in a what market? Principal market, first choice. This is the word used in IFRS 13, very important word, tested in examinations regularly is this word, called the what market? Principal market. Principal market refers to a market, principal market refers to the market with the highest volume, refers to a market with the highest volume, alright, traded. You have some of the highest volumes traded in this market, and fair value will be selling price of that particular asset less any transport costs. From this principal market, you take the selling price less any transport costs, or what we sometimes call as also market entry costs. Alright? Take selling price, it's a market with the highest volume traded, alright? And fair value is defined as selling price less any transport costs or market entry costs. Transaction costs will not be considered in deriving fair value. Right? Any transaction costs will not be considered. Will not be considered in deriving fair value. Transaction costs do not come in the derivation of fair value. Then number four, if due to some reason you cannot enter the principal market, there are barriers, barriers, cannot go into the market. The highest volume market you cannot enter for some reason. If you cannot enter this market, then you shouldn't use this value. Then what value to use? Then you take the value from another market called the most advantageous market. First choice is the what market? Principal market. If the market you cannot enter for any reason, then principle number 4 applies. And what is principle number 4? This, the standard says, in the absence, if there is no principal market, or you cannot enter the principal market due to some restrictions, for example, so in the absence of principal market, transaction is assumed to take place. Transaction is assumed to take place in another market called the most advantageous market. Take place in the most advantageous market. This word called the most advantageous market is the first choice or second choice? Second choice. If you cannot get the principal market, then take from the most advantageous market, which is the market with the highest selling price. Most advantageous market is the market with highest net selling price. And the word net selling price covers selling price less both transport costs and transaction costs can minus if it is a what market? If it is a most advantageous market, then you take selling price less both transport cost and transaction cost. Both you can minus only if you are using which one? Only if you are using the most advantageous market. These are the 4 principles fundamental in IFRS 13. And because it is very confusing, alright, they came up in FRS 113 with how to decide the level of input to be used. So IFRS 13 uses a 3-fold valuation approach. In other words, when you determine fair value, this is the fundamental basic principle, but to do a proper valuation, sometimes you cannot get any market value. Then how? If there's no market value, as long as there's a principal market, most advantageous market, you can do all days, right? If there's no market at all, but you want to do fair value, then how? Then there must be a way to do it. So the standard applies 3 steps to doing a valuation. How? They use a 3-fold valuation approach. 3-fold valuation approach based on market, income, or cost. Based on market, income, or cost. It also requires, in giving you this 3-fold valuation approach, it also requires company to maximize. It also requires your company to maximize observable inputs. Preferably, it must be something which is observable, which is always from the market. But if you really cannot get an observable input, then there are other options available, which you got to follow the standard again. So you must maximize observable inputs by using a fair value hierarchy. By using something called a fair value hierarchy. What is a fair value hierarchy? If you look at page 50, Alright? If you look at page 50, 51, there is a fair value hierarchy on page 51. Do you see? And on page 51, the fair value hierarchy gives you 3 levels of input. What are the 3 levels of input? If you follow, first is called the level 1 input. What is a level 1 input by definition in IFRS 13? Level 1 input, please take note, is any unadjusted price, unadjusted quoted price, unadjusted quoted price in an active market. Everywhere they always recommend what first? Market, active market, observable. These are the key words IFRS 13 wants you to use. So, is unadjusted quoted price in an active market for the asset. Active market for the asset. For example, if I want to value my share investment in my company, what should I do? I invested buying another company share. If I invest in another company, in my books I call it investment, right? Investment must be at what value, please? Fair value. So I bought the shares 2 years ago. If I want to bring it to current fair value, what level of input should I use? For the share, there is an active market because stock exchange got price every day, right? Right? That is an unadjusted price in a what market? Active market. So I can take the stock exchange price on December 31st and value the share very well using level 1 input, which is an observable input, right? First choice is always what? First choice is always actively traded market I can observe. That is always the first choice for fair value. If you cannot get that value, then we look at others. But the priority is always an observable price. Example, for investment, I can look at stock exchange price. For investment, I can look at stock exchange price. So level 1 means always active markets. Active markets are those where transaction take place. Those where transaction takes place with sufficient frequency and volume. With sufficient frequency and volume. Frequency and volume for pricing to be provided. For pricing, alright, to be provided. So, anywhere there is a lot of trading happening, that is the best price you can find for fair value. That's why it's always a market which is called a what marketplace? Principal market level 1. So, level 1 refers more to a what market? Principal market. If you really cannot find, then you go to level 2. Alright? If you can't get an active market, then you go to level 2 input to determine what? To determine fair value. And IFRS 13 guide you on level 2 as well. What is a level 2 input? Very simple. This refers to inputs other than quoted prices in an active market. Right? So inputs other than, we look at inputs other than quoted prices in level 1. Because we don't have an active market, we have to look at inputs other than quoted prices in level 1, and these inputs are directly or indirectly observable for that asset supported by market data. What the hell is that? Yes. Inputs other than quoted prices in level 1 that are directly or indirectly observable for that asset. for that asset supported by market data. Supported by market data. And this market data could be, example of market data could be interest rates. Market data could be interest rates, could be credit spreads related to the asset, interest rate, credit spread, or it could be yield, all these factors come in, called observable for direct input that are directly or indirectly observable, supported by market data. What is this? For example, if you don't see example, they're all very blur English. For example, if you take bond, bond? If you invest in bond, and a bond which is not traded, if the bond is not traded, how to do fair value? Right? You buy a company bond and the bond is not traded in the market. If a bond is traded in the market, you can easily find the fair value, right? Because it's level 1. But if you buy a bond which is not traded, can you value the bond accurately? Yes, you can, by using what input? Level 2 input. Because basic finance tell you clearly, when you learn your F9 paper, because P2 come after F9, in case you don't know. But when you do your F9 paper, you learn clearly, bond values and interest rates are inversely related. Have you heard before? Where did you know that? Finance. So, how do I do a fair value for a bond? Because you cannot keep what cost? Historical cost. Listen, it's not true representation of an asset. So, how do you bring the bond to fair value? You want to report the bond. I follow my logic in finance. I look at the interest rate moving and I decide my bond value based on interest rate, which is a finance problem. You don't require to value, but you must tell them how to do it, that's all. So a bond which is not traded, can I find a fair value? Yes, I can. How? The concept in finance is bonds values are related to what rate? Interest rate. Interest rate in the market can move up or down. So by December 31st, if interest rate go up, bond value will go down. That is how valuation is done. It is proven to be true in finance. Therefore, we follow that logic, and we follow that by supported by what data? Market data, because interest is market data, right? So, if interest rates are rising, we have to bring a fair value lower for the bond. If interest rates are falling, then we can increase the bond value higher. But somehow we need a what value? We need a fair value. And of course there will be percentage changes which you learn in finance how to value. That is not our subject problem, that is a finance problem. So you can do a valuation using market data, which is interest rate linked to what value? Bond value, by doing the what relationship? Inverse relationship. This is an example of what input? There is no price for the bond, but we can do a valuation by using what rate? Interest rate. If that is also not possible, then we come to number 3. What is number 3? 3 is level 3 input. Got it? 3 is, we go to level 3 input. Level 3 inputs are unobservable inputs and should be used as little as possible, kept to a minimum. We always don't like to use level 3, but sometimes you're forced to use level what? Level 3. And this was brought in because of one area, which is agriculture. Agriculture used to be a huge problem in fair value. You know why? If you run a dairy farm in Australia, right? If you run a dairy farm, you have cows, sheep and everything, right? Are cows and sheep asset? Cows and sheep, are they asset? In a farming business, what is your main asset? Land, of course. If you're growing something, the plants are asset. If you are rearing cows and sheep, they are also what? Asset. So what used to be the reporting before they brought all these things inside? When a cow is born, it's free. You know that, right? Nature give you free. So what happened? the cow starts free, zero cost, and the cow grow 1 year old, still zero cost, 2 year old, still cost is zero because they keep what cost? Historical cost. Or if you buy a 1 year old cow, you pay $200, your cow remains at 200 and the cow is already giving you milk now, understand? And the cow is already 10 years old, giving you milk, you still keep at $200, which is totally lying to the shareholder, right? Yes or no? And the worst part is the cow born free, Free means zero cost, right? So the cow never gets reported on the balance sheet, zero forever. But the cow is already giving you milk. And today definition say what? Come. Definition say what? Asset is resource controlled by entity. Do you control the cow? Yes. It's a result of past event. God gave you, okay? Okay? Future what? Does the cow give you future economic benefit? Milk benefit, and later beef, hello? All these are called what? Future benefit, what? Hello? So does the cow give you future revenue? Yes. So is the cow an asset? Yes. But what asset is it? Please don't say it. Non-current asset, depreciate. Hello, that's no problem. We call it a special asset in IAS 41, biological asset. It's a special category of asset called biological asset which will not depreciate. But it is an asset. If it is an asset, when the cow grows, the value should also... See, we don't do all this in Singapore, so we have difficulty in seeing. But it's all practical problems. So, when the cow grows, the value in the balance sheet should also grow, right? Right? So how to value? The cow was given free. So 1 year old cow, if the 1 year old cow is traded in the market, level 1. Okay? Why? Active trading of the cow. Do you follow? But if the cows are never bought and sold in the market, then very hard to value cow. Cow cannot move with interest rate, right? Correct? Hello? So I can't find a market price for the cow. I got no interest rate for anything to link to the cow. I can only see the cow growing bigger in size, you know. But I know the cow when I sell got value, right? So you cannot get a market price, then how? Then you come to level 3. Understand? That's why we need level 3. So how to do level 3? Level 3 therefore is anything which is unobservable. Level 3 is unobservable inputs. Unobservable inputs. Got it? Unobservable inputs and should be kept to a minimum. Standard warn you, this should be kept to a minimum. In fact, we only use this if there is no level 1 and level 2. This should be kept to a minimum. Should be kept to a minimum in determining fair value. In determining fair value for an asset, under level 3, what should the company do? Company will use forecast cash flow. Company will use forecast what flow? Cash flow. Alright? From asset. Any forecast cash flow from asset and use PV to determine fair value. And use PV to determine fair value. How do we do this? Very simple. Take the cow example, it's easier to see. Today the cow is 1 year old. It doesn't give you milk. Understand or not? For a cow to give you milk, it must be 5 years old, let's say. So it will only start giving you milk after it's 5 years old. And it can give you milk for the next 10 years until it's 15 years old when the cow stops giving you milk, you estimate. So 10 years it gives you milk. One cow, roughly, you know how much milk you get. You get a future cash flow done for the how many years? 10 years. Take all the 10 years cash flow coming from the milk, do a what? PV to today. All the future cash flow from the cow, do a PV to today. That PV will be the cow value today. And every year you must unwind because the cow is growing bigger. Cow grow bigger, value must grow higher. So you must do things like this under level 3, which of course is very, very difficult. That's why it's called a what input? observable input, and should be kept to a what? Minimum. But this is where we bring in PV a lot to determine fair value. So when I do IAS 41, you have to go through all this because you use a lot of level 3. Because level 3 is very useful whenever you can't find any linkages. So this is what you call level 3 input. So if you look at the concept of fair value from the 3 levels, this is the logic you must see. Just to summarize, for example, if I want to do a fair value for my property, I should use level. If I want to do a fair value for my property, I should use level 1. Why level 1? Because property got active trading, right? Assuming the property is traded, you can use level 1. A listed company share. A listed company share, I can also use level 1. They are all observable inputs in a principal market. Yes or no? First choice, right? Once you got the observable input, forget about the other levels, don't bother. Alright? Then, if I look at an unlisted company share, if the company is not listed, private limited, then I bought this share in my friend's company. I'm one of the shareholders there, but it's a private limited company. The shares are not traded. How do I value the share? Level. How to value an unlisted company share? Again, I like to take your understanding back to a little bit of F9. That's why we learned that the paper, you see. In F9, have you heard of the DVM model? What the hell is that? Dividend valuation model, have you heard? The value of a share is equal to the PV of future cash flow from the share taken to perpetuity. The only cash flow on a share is the one. Whether you hold private, limited or listed company, what do you get every year for holding a share? Dividend. So the dividend cash flow you estimate for the next few years, bring it to perpetuity, value the share today. So it's actually level 3. Why level 3? Because you're doing PV of dividend what flow? Cash flow. PV of dividend cash flow is level what? Level 3, not level 2. So all unquoted companies, we can value the fair value using level 1, level 3. If you have a brand in your company, level brand in your company brand, level your company brand. Yes. If you have a very good brand, how to value the brand fair value? Your brand is called Quaker Oats. Are you a well-known brand? Yes. Does the brand have a value? Every year must do fair value. How? To do a fair value for brand, what to do? Level 1. You cannot sell the brand, right? There's no heavy trading on your brand because your brand is unique, right? So level 1 cannot find. Level 2, brand cannot link to any of this one. There's nothing to link to a brand, right? So there's only one way. Brand creates future what flow? Brand generates future what flow? Cash flow. Bring the cash flow to PV is a value. So all brand must use level 3. Now that line the exam to decide. Think straight and keep talking to yourself. Life is easy. No. Very important. We don't memorize. Understand, then use the logic in the exam. Read the scenario, apply. Then after brand, bond investments. How to value? Level. If it is traded, if a bond investment is a traded bond, level 1. Anything traded, we can use level 1. If the bond is not traded, level 2. Why level 2? You must link to a market variable like interest rate. So anything you link to market variable is level 1, level 2. This is what IFRS 13 want you to understand in summary. So please take note. Questions that come out will hit you on these things clearly. 4 principles and 3 levels. Understand? To simplify IFRS 13, 4 principles and 3 levels. This is what you will see in the article when you read. After you finish reading, alright, if you turn to page 50, if you turn to page 61, hello? Don't worry about the time, it's only 10 o'clock. It's going to be very normal. So please take note, cannot finish before 10:15, I'm sorry. Page 61, can you see yen now? Yes or no? If you look at yen now, that is a previous examination question from June 15 on this standard. This is how they set the question. Go and have a look. I want to discuss with you in detail next lesson. Then on page 63, there is another question on IFRS 13. Wherever you see FRS 113, change it to IFRS 13. Singapore is FRS what? 113. I took the question from the Singapore paper, so it's FRS 113. You're going for the international paper, it is IFRS 13. Got it? So, IFRS 13, there's another beautiful question on page 63. Got it? Try these two questions based on today's rules. Alright? Do as far as you can. Wrong, never mind. Try first. Bring the answer. Next lesson, I will show you how to apply your knowledge which you have. You must learn the standard and the application together. Please take note, that's how you handle a P2 paper. Because just learning the theory will not help understand the subject. There's a lot of details inside. You must know what detail the examiner expects from you. That's why I collected all the questions for you behind. Got it? So every standard you finish, there will be enough questions for you to go back and enjoy. So sit and do it, practice and come. I promise you, life will be very easy. Alright? So go and apply. I'll see you next week to continue our